Here is a puzzle that should not happen. China, the country that makes half the world's steel, just imported a record amount of iron ore. More ore than ever before. That sounds like booming demand, and iron ore miners like Vale should be flying. But look at the second number. China's actual steel output is falling, down 5 straight months. So the country is buying more of the raw material while making less of the finished product. Where is all that ore going? Ticker VALE, one of the biggest iron ore miners on Earth, and it screens cheap. So, is this record buying a real demand signal or a mirage? Let's take it apart. No buy call, just the mechanism. Start with the number that looks bullish. China's iron ore imports hit a record, around 1.26 billion tons in 2025, the most it has ever brought in. And 2026 is forecast to be near record too. For a miner like Vale, that is the top line you want. The single biggest customer on the planet, buying more ore than at any point in history. If all you saw was the import figure, you would call this peak demand for iron ore. And that is exactly the read the bulls point to. But here is the catch, and it breaks the demand story. China is importing record ore while making less steel. Crude steel output has fallen for 5 straight months, from about 86 million tons a month a year ago to roughly 82 million now. If you buy more raw material but produce less finished product, the raw material has to go somewhere, and it is piling up in port inventories, not flowing into steel. China's property sector is weak, so the mills do not need it yet. That record import is not consumption. It is stockpiling, a demand signal that may be a demand mirage. And now, the other blade of the scissors, supply. A giant new mine called Simandou in Guinea just started shipping high-grade ore, 65% iron. Its first cargo left in January. About 20 million tons come this year, and it ramps toward 120 million tons a year by 2030. That is an enormous new river of ore pouring into a market that is already oversupplied, while the demand signal is a mirage, more supply into softening real demand. Forecasters see iron ore averaging around $95 a ton this year, dipping toward $90 in the back half. So, which is it? A cheap value or cheap for a reason? The bull case. Vale is one of the lowest cost, highest quality iron ore producers in the world. It survives price dips that kill higher cost miners. It pays a real dividend, and if China ever restocks for real, it has the volume. The bear case. The demand signal is a stockpile, not consumption. Real steel output is falling, and Simandou is flooding new supply into that softness. A low-cost survivor or a value trap where the cheap price is pricing a demand mirage and a supply glut at the same time. So what actually settles it? One line, and it is not the import figure. Watch China's steel output. Imports can spike on stockpiling and tell you nothing about real demand. Steel output is the true consumption signal. It is what the ore is actually turned into. If steel output stabilizes and turns up, the record imports were early restocking and the ore starts flowing into mills. The low multiple was a value. If steel output keeps falling while ore keeps arriving, the inventory just grows. Prices grind lower as Simandou ramps, and cheap was cheap for a reason. Steel output, not imports, is the tell. So, back to where we started. Record ore bought, less steel made. Right now it is simply too early to call. The import number looks like a boom. The steel number says the boom may be a stockpile. Two signals pointing opposite ways, with a giant new mine ramping into the gap. Watch the steel output line, not the import headline. That is the one that settles it. This is educational analysis of public data, not investment advice. Verify every number yourself before you act on any of it.